Welcome to the Q&A review for the Pennsylvania Life Accident and Health Insurance exam. We'll break down why each correct answer works, why the others fall short, and the reasoning behind it. Here's the practice set we'll cover. Insurance principles and concepts, life insurance policies, annuities and retirement income, accident and health insurance, Pennsylvania laws and regulations. Our website is loaded with free exam guides and practice questions built to help you ace this exam. You'll find everything you need to review key concepts, test your knowledge, and build real confidence before test day arrives. So check out the link below. Dive right in and start studying smarter, not harder, starting today. All right, let's get started. Question 1. A producer in Lancaster wants to market her practice under a trade name rather than under her own legal name, and she asks what Pennsylvania requires before she starts using it. Which of the following describes her obligation? Your options are A. Notify the department before using the name. B. Register the name with her county. C. Obtain written consent from each insurer. D. Nothing, provided the name is truthful. Which one is it? Pause the video if you need more time. The correct answer is A. Notify the department before using the name. A is correct because a Pennsylvania producer doing business under any name other than her legal name must notify the insurance department before using it, and the department may disapprove a name that would mislead consumers. B is wrong because county filings serve general business purposes and tell the insurance regulator nothing. The department needs its own notice so it can screen the name for potential to confuse the public. C is wrong because insurers care which producers represent them, but they do not police assumed names. That review belongs to the department, which can reject a name outright. D is wrong because truthfulness alone does not satisfy the statute, because a name may be accurate and still misleading. Advance notice gives the department a chance to decide that question. A producer's license is tied to one name, and that name is how regulators and consumers trace her history. When she markets under a different name, that thread breaks. The rule is short but strict. The obligation runs specifically to the insurance department. It must happen before the name goes into use, and the department has real power to reject a name it finds misleading. A name can mislead in specific ways, implying government affiliation, implying the agency itself is an insurance company, or borrowing a carrier's established goodwill. None of these harms can be fixed after the name is already on signage, which is why review has to happen first. Candidates often reach for the wrong authority. A county fictitious name filing covers contract and creditor purposes, not consumer protection. A carrier appointment governs who can submit business, not what name the public sees. And a truthful name still isn't automatically approved. Only the insurance department's own review satisfies this rule. Whenever a stem mentions an assumed name, trade name, or doing business as, the answer runs to the insurance department, and it runs before that name is ever used. Question 2. One report an underwriter orders simply verifies facts from records and prior applications, while a second involves interviewing neighbors and associates about the applicant's character and habits. Which of the following describes the applicant's rights regarding the second report? Your options are A. The applicant may block it entirely. B. The applicant need not be told. C. The applicant must give consent for it. D. The applicant may charge a review fee. Take a second. Which answer would you pick? The correct answer is C. The applicant must give consent for it. C is correct because an investigative consumer report gathers information through personal interviews about character, reputation and habits, and the applicant must consent to it. An ordinary consumer report requires only that the applicant be informed. A is wrong because consent is required, but an outright veto would let anyone with something to hide stop underwriting cold. The applicant's remedy is to decline the coverage rather than to forbid the inquiry. B is wrong because silence would leave an applicant unaware that acquaintances were being questioned about him. Federal credit reporting law places notice and consent obligations on exactly this kind of report. D is wrong because no fee arrangement exists in either direction. Consumers may dispute inaccurate information at no charge, and they cannot bill an insurer for the privilege of being investigated. An investigator asking neighbors about someone applying for life insurance reveals a split in the law itself. There are two categories of consumer report, and the difference between them decides what rights an applicant actually gets. An ordinary consumer report just compiles information already sitting in records. Credit history, prior applications, motor vehicle records, public filings. Because that data already exists and can be disputed, simple disclosure that a report may be obtained is enough. An investigative consumer report works differently. Its defining feature is that information about character, general reputation, personal characteristics, and mode of living is gathered through personal interviews with neighbors, friends, and associates, which is exactly why the law demands more than a heads up. Applicants know their own health and habits far better than any carrier can, so third-party reports close that information gap. Federal law doesn't shut the gap back up with a veto power. It regulates how the closing happens, which is why refusing consent costs the application, not the investigation. Whenever you hear interview, neighbors, friends, or mode of living, that's an investigative report requiring consent. Whenever it's records or prior applications, that's an ordinary report where disclosure alone does the job. Question 3. Two people apply for Pennsylvania producer licenses on the same day. One lives in Pittsburgh and the other lives in Delaware and will write here as a non-resident. Which of the following correctly describes the fees each pays? Your options are: A. Both pay the same statutory fee. B. The non-resident pays less than the resident. C. Only the resident pays a fee. D. The non-resident pays twice the resident fee. Before I reveal it, which one do you think is right? The correct answer is D. The non-resident pays twice the resident fee. D is correct because Pennsylvania charges a resident producer license fee of $55 and a non-resident fee of $110. So the non-resident applicant pays twice what the resident pays. A is wrong because identical fees would ignore the different fee schedules the statute sets. Pennsylvania distinguishes resident and non-resident applicants in both the initial fee and the renewal amount. B is wrong because charging a non-resident less would give out-of-state producers an advantage over people licensed and living here. The statute runs in the opposite direction. C is wrong because non-residents pay a licensing fee as well, and it is the larger of the two. Waiving it would leave the department without any charge for processing an out-of-state application. Pennsylvania charges a resident producer $55 and a non-resident producer $110, exactly double. That ratio isn't random, and understanding why reveals how licensing actually works. A resident license is primary. The applicant completes pre-licensing education, passes the exam, and undergoes background review at home. A non-resident license is derivative, built on a license issued elsewhere so the producer can write business without repeating that qualification process. States built a reciprocity framework so a licensed producer doesn't repeat the entire process everywhere she writes business. She submits proof of her home state license, skips Pennsylvania's exam and coursework, and her home state keeps responsibility for having qualified her in the first place. The higher non-resident fee isn't a penalty. It buys access to a market where the state did none of the qualifying worker. Identical fees ignore that two schedules exist, a lower fee would favor outsiders, and no state processes applications for free. That same doubled relationship carries through at renewal, not just initial licensure. Watch for the word non-resident and anchor on the doubling. 55 for residents, 110 for non-residents at licensure and at renewal alike. Question 4. A Pennsylvania beneficiary reads the front of a life policy and finds the company's promise to pay a stated sum upon receipt of due proof of the insured's death, signed by an officer. Which of the following names that provision? Your options are A. The consideration clause, B. The entire contract provision, C. The insuring clause, D. The payment of claims provision. What's your answer? Commit to one before I continue. The correct answer is C. The insuring clause. C is correct because the insuring clause states the insurer's central promise to pay the face amount on due proof of the insured's death. It appears on the first page and carries an officer's signature. A is wrong because the consideration clause identifies what each side gives, meaning the application statements and premium in exchange for the insurer's promise. It describes the bargain rather than stating the promise. B is wrong because the entire contract provision lists the documents that form the agreement and limits how the contract may be changed. It settles disputes about content rather than announcing coverage. D is wrong because the payment of claims provision governs to whom and how quickly proceeds are paid after a claim. It operates after death rather than establishing the underlying obligation. Every life insurance policy opens with the same crowded first page, and 4 provisions living inches apart cause most of the confusion on exams. Let's sort them out by understanding what each one actually does. The insuring clause states the company's actual promise to pay. The consideration clause explains what each side gave in exchange, application statements and premium against the insurer's promise. And the free look provision opens a short window to return the contract. The insuring clause names the insured and beneficiary, states the face amount, and conditions payment on due proof of death. It carries a corporate officer's signature, since a corporation can only promise through an authorized person, which is why no producer can rewrite what that officer signed. Consideration matters at formation, explaining why the contract is binding at all. The insuring clause matters as the standing obligation from issue until the policy ends. Entire contract matters when a dispute arises over content or an attempted change. Payment of claims matters after death, governing how proceeds are delivered. Memorizing these 4 as flat vocabulary is where candidates get stuck. Filing them along this timeline, formation, obligation, dispute, and death, is what makes them stop being confusing. Question 5. A Pennsylvania producer reviewing her agency's compliance calendar asks whether anyone at all is excused from the Commonwealth's continuing education requirement for the current 2-year license period. Which of the following groups does the statute exempt from those credit hours? Your options are A. Producers holding more than 2 lines, B. Producers over the age of 70, C. Producers whose commissions fall below a threshold, D. Limited lines licensees and business entities. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Limited lines licensees and business entities. D is correct because Pennsylvania exempts limited lines licensees, business entities, producers continuously licensed before 1971, and non-residents who satisfy their home state's requirements from the continuing education obligation. Every other licensee completes the hours. A is wrong because holding several lines increases what a producer must know rather than excusing the requirement. Nothing in the statute reduces credit hours as lines of authority accumulate. B is wrong because age alone creates no exemption in the Commonwealth. The one longevity-based exception turns on continuous licensure since before 1971 rather than on birth date. C is wrong because earnings play no role in the education rules. A producer writing a handful of policies owes the same credit hours as one running a large agency. Continuing education looks like it should reward common sense, but in Pennsylvania, it doesn't work that way. Volume, age, and complexity never excuse a producer from continuing education. Only 4 specific exemptions exist, and everyone turns on license category or where the primary license lives. Pre-licensing education and the exam prove a producer knew the material on day 1. Continuing education solves a different problem. Insurance law, tax treatment, product design, and federal overlay all keep shifting while a license sits unused. 4 exemptions exist, each with its own logic. Limited lines licensees hold a narrow authority, not a full practice. Business entities are organizational, so the individuals under them carry the obligation instead. Producers continuously licensed before 1971 are grandfathered, and non-residents who satisfy their home state's requirements are exempt here. The non-resident exemption fits a larger pattern. The home state qualifies the producer, and every other state extends recognition rather than rebuilding the process. A producer licensed in 8 states completes 1 education cycle, not 8, as long as that home license stays in good standing. The grandfather date is about unbroken licensure, not age, and a lapse breaks it entirely. Volume never scales the requirement because education tracks consumer exposure, not producer income. When a question asks who's excused, check each option against these 4 exemptions, not against what feels fair. Question 6. Rather than mailing a check, a Pennsylvania insurer credits the death benefit to an interest-bearing account in the beneficiary's name and sends her a checkbook so she may draw on it. Which of the following settlement arrangements is this? Your options are A. A fixed period option, B. A spendthrift arrangement, C. A retained asset account, D. An automatic premium loan. Which would you go with? Lock it in before the reveal. The correct answer is C. A retained asset account. C is correct because a retained asset account holds the death benefit for the beneficiary in an interest-bearing account she may draw against, giving immediate access without forcing an immediate decision about the money. A is wrong because a fixed period option spreads the proceeds and interest across a chosen number of years in scheduled payments. The beneficiary cannot simply write a check for whatever she needs. B is wrong because a spendthrift arrangement restricts a beneficiary's access and shields proceeds from her creditors. Handing her a checkbook is the opposite of restricting access. D is wrong because an automatic premium loan borrows cash value to keep a policy in force during the insured's life. It has nothing to do with how a death benefit is delivered. Before modern settlement options, a death claim ended with a check for the full amount, mailed straight to a grieving family. That created a real problem. Consequential money decisions made in the worst possible moment. Instead of mailing a lump sum, the insurer credits the death benefit to an account in the beneficiary's name and gives her a checkbook. She can draw the entire balance immediately, but anything left behind earns interest on its own schedule. Mechanically, the funds never leave the insurer's own operation. The insurer holds the money, credits interest, and honors drafts through a processing bank, which means protection comes from the State Guarantee Association framework, not federal deposit insurance. 4 lookalikes point in different directions. The fixed period option trades access for scheduled installments. A spendthrift clause restricts access to protect against creditors. An automatic premium loan borrows cash value while the insured is still alive. Only the retained asset account gives immediate, unrestricted access with no trade-off. Whenever you see a checkbook, a draft book, or language about immediate access without forcing a decision, that's the retained asset account signature. Question 7. A Pennsylvania agency wants to pay a finder's fee to an unlicensed acquaintance who steers prospects to it and then helps explain policy terms and benefits to them. Which of the following describes what the licensing article permits? Your options are: A. Payment is permitted if it is disclosed. B. Payment is permitted up to a cap. C. Payment is permitted with insurer approval. D. Commissions may not go to unlicensed persons. Don't overthink it. Which one feels right? The correct answer is D. Commissions may not go to unlicensed persons. D is correct because Pennsylvania prohibits paying commissions or other valuable consideration for selling, soliciting, or negotiating insurance to a person required to be licensed who is not. Explaining policy terms crosses into negotiating. A is wrong because disclosure does not cure a payment the statute forbids. The prohibition protects consumers from unlicensed advice rather than merely requiring that the arrangement be visible. B is wrong because no dollar threshold appears in the provision. A small payment for licensable activity is prohibited on the same terms as a large one. C is wrong because insurers cannot authorize what the statute bars, and an insurer that knowingly accepts business from an unlicensed person faces its own penalty of up to $5,000. Pennsylvania's licensing law draws a hard line around 3 verbs, and everything about paying unlicensed people turns on them. Selling, soliciting, and negotiating insurance for compensation require a license, and that prohibition has no disclosure exception, no dollar threshold, and no path to approval. Soliciting means attempting to sell or urging someone to apply. Negotiating means conferring with a prospective buyer about a policy's benefits, terms, or conditions. So explaining what a policy covers and costs is itself the Licensee Act. A bare referral, just handing off a name, sits on one side of the line. The moment that person starts explaining what the policy does, the payment becomes compensation for negotiating, no matter what it's called. Licensing guarantees that anyone giving insurance advice has met education, exam, and character standards and stays accountable to the department. An unlicensed advisor sits outside all of that. So a consumer harmed by bad advice has no regulator to turn to and no license to revoke. Disclosure, a cap, insurer consent, good intentions, none of it matters. The only question is whether the person sold, solicited, or negotiated. If they did, compensation is prohibited, full stop. Question 8. A Pennsylvania insurer wants to require a blood test as part of underwriting a large life application, and the producer explains the rules that govern such testing. Which of the following conditions applies to testing for that condition? Your options are: the insured's written consent is required. B. Testing may be based on geography. C. The application may ask about sexual orientation. D. Results may be shared without restriction. Got a guess? Lock it in. The correct answer is A. The insured's written consent is required. Is correct because testing related to that condition requires the insured's written consent. Applications may not ask about sexual orientation, and an insurer may not select applicants for testing based on where they live. B is wrong because choosing whom to test by geography would substitute a proxy for individual risk assessment and would reach people because of their neighborhood. That practice is expressly out of bounds. C is wrong because questions about sexual orientation are prohibited on insurance applications, and they would not predict mortality in any event. Underwriting must rest on medical evidence instead. D is wrong because results are sensitive health information subject to strict privacy handling. Sharing them freely would violate both the consent the applicant gave and the privacy rules that follow it. Underwriting depends on distinctions that actually predict mortality, not ones that merely correlate with a group of people. When HIV testing arrived in the 1980s, Insurers gained a genuinely predictive tool right as public fear outran medical understanding, and states had to draw careful lines around it. 4 rules carry the framework. Testing requires the insured's written consent. Applications may not ask about sexual orientation. Insurers may not select applicants for testing based on where they live. And results are sensitive health information subject to strict privacy handling. Each rule closes a door that others leave open. Written consent is the foundation, and it means more than the routine authorizations applicants already sign for medical records. A positive result carries consequences reaching into employment, relationships, and future insurability. So specific written consent lets the applicant choose to learn and record that outcome rather than stumble into it. Orientation questions are barred because sexual orientation does not predict mortality while health status does, so once a carrier can test directly, reaching for that proxy is unlawful and analytically lazy. Geographic selection is redlining in a lab coat. Closing the door orientation questions would otherwise leave open. Unrestricted sharing would make consent worthless, so confidentiality completes the system. Testing itself stays entirely permissible. What the framework governs is how it gets triggered and handled. Consent must be in the file, orientation can't be asked. Address can't drive the decision. And results stay confidential. That's the fastest way through any question on this topic. Question 9. A Pennsylvania insurer cannot finish investigating a claim within the period the regulation allows, and the claimant hears nothing further. Which of the following describes the status letters the insurer must send after the initial investigation period passes? Your options are A. A single letter after 90 days. B. Nothing further until the claim is decided. C. A letter every 45 days thereafter. D. A letter every 6 months thereafter. Which one is it? Pause the video if you need more time. The correct answer is C. A letter every 45 days thereafter. C is correct because Pennsylvania requires an insurer to complete its investigation within 30 days after notification when reasonably possible, and when that is not possible, to send the claimant a status letter every 45 days thereafter. A is wrong because 1 letter after 3 months would leave a claimant uninformed through most of a lengthy investigation. The regulation requires a repeating cadence rather than a single update. B is wrong because silence during a long investigation is precisely the conduct the unfair claim settlement rules were written to stop. The duty to communicate continues while the file remains open. D is wrong because a 6-month interval is far longer than the regulation permits and would make the notice requirement almost meaningless in ordinary claims. Claimants would learn nothing for half a year. A claim can sit for months with no word from the insurer, leaving the claimant unsure if anyone is even working on it. That silence is exactly what Pennsylvania's unfair claim settlement regulations were written to prevent. 2 intervals carry the rule. The insurer must finish within 30 days when that's reasonably possible. When it isn't, it must send a written status letter, then another one every 45 days for as long as the file stays open. A single notice would let an insurer explain itself once and then go quiet indefinitely. A repeating obligation instead creates a recurring internal deadline, forcing someone inside the company to look at the file every cycle and say why it's still open. The 30-day figure isn't a strict deadline for every claim, because some investigations genuinely can't move that fast. A contestable death claim needs records from multiple providers. A disability claim needs physician statements, and an out-of-state incident depends on records the insurer can't compel quickly. The regulation accommodates slow investigations but never silent ones. Each status letter must explain the reason for delay, so the claimant always knows what the file is actually waiting on. Question 10. An actuary explains that one figure reflects only mortality reduced by expected interest earnings. while a second figure adds the insurer's operating costs to that first amount. Which of the following correctly names these two figures in that order? Your options are A. Modal premium and annual premium, B. Net premium and gross premium, C. Level premium and single premium, D. Earned premium and unearned premium. Take a second. Which answer would you pick? The correct answer is B. Net premium and gross premium. B is correct because the net premium reflects mortality reduced by expected interest, and the gross premium adds the insurer's expenses to that amount. The gross figure is what the policy owner actually pays. A is wrong because modal and annual premium describe how often the policy owner pays rather than what the premium contains. Paying more frequently raises the total without changing the underlying components. C is wrong because level and single premium describe the pattern of payment over time, meaning a steady amount or one lump sum. Neither term separates mortality and interest from expenses. D is wrong because earned and unearned premium describe an insurer's accounting for coverage already provided and coverage still owed. Those terms measure a company's obligations rather than pricing. A life insurance premium isn't one number, it's a stack of layers, and exams test whether you can name them in order. Mortality is the expected cost of death claims. Subtract expected interest earnings and you get the net premium. Add expenses and you get the gross premium, the figure the policy owner actually pays. Mortality tables estimate how many insureds will die and what those claims cost. Interest reduces that figure because insurers earn money on premiums held for years before claims come due. What's left after expenses are added becomes the gross premium, the number on the bill. 3 other term families crowd this space and none of them describe what's inside the premium. Modal versus annual is about how often you pay. Level versus single is about the payment pattern over time. Earned versus unearned is pure accounting, describing coverage already provided versus coverage still owed. Net premium is the incomplete figure, just mortality minus interest. Gross premium is complete because it adds expenses. When in doubt, remember, gross is always what appears on the bill. Question 11. The Pennsylvania Insurance Department sends a written inquiry to an insurer about a consumer complaint, and the company's compliance officer asks how quickly a response must go out. Which of the following states the period the regulation allows? Your options are A. 15 working days, B. 30 calendar days, C. 5 working days, D. 60 calendar days. Before I reveal it, which one do you think is right? The correct answer is A. 15 working days. A is correct because every person subject to the unfair claims settlement regulation must furnish the department an adequate response to an inquiry within 15 working days after receiving it. The clock runs from receipt. B is wrong because 30 calendar days is the period Pennsylvania gives an insurer to complete a claim investigation when that is reasonably possible. It measures investigation rather than regulator correspondence. C is wrong because 5 working days is the window a replacing life insurer has to notify each existing insurer of a replacement. That deadline comes from an entirely different chapter. D is wrong because 2 months would let a company sit on a regulatory inquiry while a consumer complaint remained unresolved. The regulation sets a considerably shorter period. Pennsylvania's insurance deadlines are the most confusable material on the exam because every one involves a number of days attached to some communication. The only defense is sorting them by who is waiting and what they're waiting for. The rule at issue governs correspondence with the insurance department. Every regulated entity must furnish an adequate response within 15 working days of receiving an inquiry. 3 details matter. The clock runs from receipt, the days are working days, and the response must actually be adequate. This deadline is short because a consumer's complaint usually sits behind the letter. A slow, vague reply doesn't just annoy a regulator, it leaves a policyholder stuck without resolution, which is why a real answer is required, not just a promise of one later. 3 look-alike deadlines get swapped under pressure. 30 calendar days covers completing a claim investigation. 5 working days covers a replacing life insurer notifying an existing insurer. 15 working days and only 15 covers replying to the department itself. Whenever a STEM describes a written inquiry from the department, the target is 15 working days from receipt, with a genuinely adequate answer. Keep that separate from 30 days for investigations and 5 days for replacement notices, and the numbers stop migrating between situations. Question 12. A participating policy owner directs each dividend to buy as much one-year term coverage on her own life as the dividend will purchase at her attained age each year. Which of the following describes what this dividend option accomplishes? Your options are: A. It reduces the next premium due. B. It converts the policy to paid-up status. C. It leaves the dividend earning interest. D. It adds temporary coverage for 1 year. What's your answer? Commit to one before I continue. The correct answer is D. It adds temporary coverage for 1 year. D is correct because the 1-year term dividend option applies each dividend as a single premium for term insurance on the insured's life at attained age, adding coverage that lasts 1 year and is repurchased annually. A is wrong because reduction of premium applies the dividend against the next payment due, lowering out-of-pocket cost. The death benefit stays exactly where it was under that choice. B is wrong because the paid-up policy option uses dividends and cash value to eliminate future premiums entirely. That result ends payments rather than adding a layer of temporary protection. C is wrong because accumulating at interest leaves dividends on deposit with the insurer, where they earn taxable interest the owner may withdraw. No additional insurance results from that election. A dividend on a participating policy isn't profit. It's a refund of an overcharge, returned because the insurer priced conservatively and actual experience came in better than assumed. That's why dividends get favorable tax treatment as a return of premium rather than income. Because the dividend belongs to the policy owner, the contract offers a menu: cash, reduction of premium, accumulation at interest, paid-up additions, 1-year term, and in some contracts, paying the policy up entirely. Same dividend, 6 very different results. The 1-year term option treats each dividend as a single premium buying term insurance at the insured's attained age. That coverage lasts exactly 1 year, adds no cash value, and is repurchased the following year with the next dividend. Temporary protection layered on the base policy year after year. The key distinction is permanence. Paid-up additions buy small amounts of permanent insurance that build their own cash value and dividends forever, while 1-year term buys temporary coverage that expires and builds nothing. This makes 1-year term valuable for someone whose protection need has grown, but who might not pass new underwriting. It adds death benefit without a new application. Watch the language. Coverage lasting 1 year and repurchased annually signals 1-year term. Permanent increments that build cash value signal paid-up additions. And anything about lowering payments, earning deposit interest, or ending premiums entirely points to the other 3 options. Question 13. The Commissioner brings a civil action against a person who has committed insurance fraud in Pennsylvania on 3 separate occasions over several years. Which of the following describes how the civil penalties escalate across a first, second, and subsequent violation? Your options are: A flat amount for every violation. B, penalties double with each violation. C, $5,000, $10,000, then $15,000. D, 1,000, 2,000, then 3,000. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. 5,000, 10,000, then 15,000. C is correct because Pennsylvania authorizes civil penalties of up to $5,000 for a first insurance fraud violation, $10,000 for a second, and $15,000 for each subsequent violation, plus investigation costs. A is wrong because a flat penalty would treat a repeat offender exactly like a first-time violator. The statute escalates precisely to reflect that repetition makes the conduct more serious. B is wrong because doubling would produce 20,000 at the third violation, which overshoots the statutory figure. The increases are stepped rather than geometric, and Pennsylvania fixed each step by statute. D is wrong because these amounts are far below the fraud statute's schedule and resemble penalties from other provisions. Pennsylvania treats criminal insurance fraud as a felony with matching civil exposure. Escalating penalty schedules are a deliberate design choice in regulatory law. A flat fine becomes just a cost of doing business, so lawmakers make repeat violations progressively more expensive, targeting the pattern of misconduct rather than a single incident. Pennsylvania sets the steps at $5,000, $10,000, and $15,000 plus investigation costs. The climb is arithmetic, rising by $5,000 each time, and then it plateaus at $15,000 rather than escalating forever. The increases are stepped, not doubled, so assuming the third violation costs $20,000 overshoots the statute. The schedule also stops climbing after the second step, a common ceiling in regulatory law. Lower figures like 1, 2, or 3,000 belong to entirely different provisions. These civil penalties sit alongside criminal exposure, not instead of it. Pennsylvania treats insurance fraud as a felony-grade criminal offense, so a person can face prosecution and incarceration on one track while civil penalties run separately on another. Expect a repeat violator and a question about escalation. 5,000, 10,000, 15,000, with that third figure holding steady for every violation after, plus investigation costs. Committing those figures and the plateau to memory is the whole of the task. Question 14. A Pennsylvania producer explains to a client that one product protects against dying too soon, while the other protects against a different risk entirely. Which of the following correctly describes the risk that an annuity is designed to address? Your options are A. The cost of a final illness. B. The risk of outliving one's income. C. The loss of a key employee. D. The expense of settling an estate. Which would you go with? Lock it in before the reveal. The correct answer is B. The risk of outliving one's income. B is correct because an annuity protects against outliving one's resources by converting a sum of money into income the annuitant cannot exhaust. Life insurance protects against the financial consequences of dying too soon. A is wrong because final illness expenses are met from death proceeds or medical coverage rather than from an annuity. The contract pays a living person rather than reimbursing a decedent's bills. C is wrong because key employee exposure is addressed with life or disability coverage owned by the business. An annuity accumulates and distributes money rather than indemnifying a company for lost talent. D is wrong because estate settlement costs are commonly funded with life insurance, which delivers cash at exactly the moment the estate needs liquidity. An annuity often stops paying at that point instead. Life insurance and annuities are often called opposites, and that description holds up. One protects against dying too soon. The other protects against living too long. Longevity risk is hard to manage alone because nobody knows their own date in advance. No amount of careful budgeting fixes that. Since averages describe a population, not a single person's actual lifespan. An annuity solves longevity risk through pooling, the same mechanism life insurance uses for mortality risk, just running the opposite direction. The insurer manages a large group, so those who die early fund payments to those who live long. Poor health raises life insurance premiums because it signals an earlier claim, but it can favor an annuity buyer because a shorter payout period allows a higher income. The same medical fact points opposite ways depending on which risk the contract addresses. Final expenses, estate liquidity, and key employee loss all point to life insurance, since that risk resolves at death. Outliving income points to an annuity, since that risk resolves by staying alive. Question 15. A Pennsylvania insurer wants to share a customer's non-public personal financial information with an unaffiliated company for that company's own marketing purposes. Which of the following does the Commonwealth's privacy framework require before that sharing may lawfully occur? Your options are A. Written approval from the Commissioner, B. A court order permitting disclosure, C. Nothing since financial data is public, D. Notice and a chance to opt out. Don't overthink it. Which one feels right? The correct answer is D. Notice and a chance to opt out. D is correct because Pennsylvania's privacy regulation requires an initial notice when the customer relationship begins, annual notices afterward, and an opt-out notice with a reasonable opportunity to opt out before sharing with unaffiliated third parties. A is wrong because the Commissioner sets the rules but does not approve individual disclosures. Requiring case-by-case approval would be unworkable and appears nowhere in the framework. B is wrong because court orders compel disclosure in litigation rather than authorizing routine marketing arrangements. The consumer's own choice is what governs ordinary information sharing, and nothing substitutes a judge for the customer. C is wrong because financial account information is precisely the non-public data the privacy rules protect. Treating it as public would eliminate the framework the Commonwealth adopted. Federal law from 1999 forced financial companies to finally tell customers what they do with personal data, and states built their insurance rules around that requirement. The Commonwealth's rule has 3 notice obligations: an initial notice when the relationship begins, an annual notice every year after, and an opt-out notice with a real chance to object before data goes to an outside company. Opt-out means sharing happens automatically unless the consumer speaks up, which is weaker than opt-in, where sharing would be blocked until the consumer agrees. Regulators picked opt-out because it preserved arrangements the industry relied on. The whole rule turns on who receives the data. Sharing among affiliates under common ownership is treated differently from sharing with an unaffiliated outside company, and the opt-out right attaches specifically to that outside unaffiliated disclosure. Health information demands actual authorization, not just an opt-out chance, because medical data carries greater risk of harm. Read for the category of information and the identity of the recipient, and nearly every exam question on this topic resolves itself. Question 16. One reinsurance arrangement lets the reinsurer evaluate each individual risk before accepting it, while another obligates the reinsurer to accept risks automatically under a standing agreement. Which of the following correctly names these 2 arrangements in that order? Your options are A. Facultative and treaty, B. Treaty and facultative, C. Primary and excess, D. Retention and cession. Got a guess? Lock it in. The correct answer is A. Facultative and treaty. A is correct because facultative reinsurance lets the reinsurer examine and accept or decline each risk individually, while treaty reinsurance obligates the reinsurer to take risks that fall within a standing agreement. B is wrong because reversing the labels attaches individual review to the automatic arrangement. The word treaty signals a standing contract, which is exactly what removes the case-by-case decision. C is wrong because primary and excess describe layers of coverage and which insurer pays first. Those terms allocate loss among policies rather than describing how risk is shared with a reinsurer. D is wrong because retention is the amount a ceding company keeps and cession is the portion it transfers. Both describe quantities rather than the mechanism by which the reinsurer accepts business. No insurer can safely absorb every risk it writes, so reinsurance exists to transfer part of that risk to another insurer. The whole subject boils down to two questions: how much risk moves, and by what mechanism it moves. The vocabulary is precise. The ceding company or primary insurer transfers risk to the reinsurer. Retention is what the ceding company keeps, and cession is the portion it hands off. Facultative reinsurance is the individual risk approach. Each risk is offered and evaluated on its own merits, and the reinsurer may accept or decline. Treaty reinsurance runs on the opposite principle, a standing agreement that automatically covers a whole class of business without case-by-case review. The most common error is reversing these labels. Anchor treaty to a standing agreement, like a treaty between nations, and facultative naturally attaches to individual review. Primary and excess describe coverage layers, not reinsurance structure at all. Insurers typically run treaty arrangements for ordinary business, giving certainty and efficiency, and turn to facultative for unusual or oversized risks that fall outside the treaty, trading that certainty for individual control. Question 17. A Pennsylvania buyer wants temporary coverage whose death benefit grows over the term, and she accepts that the premium will rise along with it as the years pass. Which of the following products matches exactly what she wants? Your options are level term insurance, B, decreasing term insurance, C, increasing term insurance, D, limited payment whole life. Which one is it? Pause the video if you need more time. The correct answer is C, increasing term insurance. C is correct because increasing term insurance raises the death benefit over the policy term, and the premium climbs with it. Buyers choose it when the need being protected is expected to grow. A is wrong because level term holds both the face amount and the premium steady for the entire term. Nothing about that design produces the growing benefit this buyer wants. B is wrong because decreasing term reduces the face amount over time while keeping the premium level, which suits a shrinking debt. It moves in exactly the wrong direction here. D is wrong because limited payment whole life is permanent coverage paid up after a stated period with a level face amount. It offers neither the temporary term nor the growing benefit described. Insurance works when the shape of coverage matches the shape of the need. Needs can stay flat, shrink, or grow. And term insurance offers 3 configurations built for exactly those trajectories. Level term holds the face amount and premium steady, fitting a constant need like income replacement. Decreasing term lets the benefit fall while premium stays level, matching an amortizing debt like a mortgage. Increasing term raises both the benefit and premium together for needs expected to grow. In increasing term, the death benefit and the premium climb together because a larger benefit at an older age costs more on both counts. This isn't a flaw in the design. It's simple arithmetic as risk and age both increase. Limited payment whole life is a common wrong answer because the word limited suggests something temporary. In reality, it's permanent insurance with a level face amount where only the payment period is limited, not the coverage. The fix is simple. Check whether the benefit and premium move together, apart, or stay still. A growing benefit paired with a rising premium points to only one answer, increasing term. Question 18. A Pennsylvania variable annuity owner's payments buy one kind of unit while money is accumulating. And at annuitization, the accumulated value is converted into a different kind of unit. Which of the following correctly names these two units? Your options are A. Accumulation units and annuity units. B. Annuity units and accumulation units. C. Par units and non-par units. D. Fixed units and separate units. Take a second. Which answer would you pick? The correct answer is A. Accumulation units and annuity units. A is correct because premiums paid into a variable annuity purchase accumulation units during the accumulation period. And at annuitization, those accumulated units are converted into annuity units that determine the income payments. B is wrong because reversing the order places income units in the saving stage. The conversion happens only when the owner decides to annuitize, so annuity units cannot exist earlier. C is wrong because participating and non-participating describe whether a policy pays dividends. Those labels belong to life insurance classification rather than to variable annuity mechanics, and neither term appears in annuity contracts. D is wrong because fixed products credit a declared interest rate and do not use units at all. Separate account is the name of the investment vehicle rather than a type of unit. Variable annuity payments don't earn a declared rate. They buy units in separate account sub-accounts. Understanding what those units are and what happens to them at annuitization is the mechanical core of this product. During accumulation, each payment purchases accumulation units, and the unit value moves with investment performance. Units accumulate through purchases, while value moves through performance, two distinct mechanisms that must stay separate in your mind. Annuitization is the pivot of the whole contract. Accumulated units convert into annuity units, with the number fixed based on account value, age, payout option, and the assumed interest rate, and from that point on, only the value of those units keeps moving. Each income payment equals a fixed number of annuity units multiplied by a current unit value. Performance above the assumed interest rate raises the payment. Performance below it lowers the payment. The annuitant keeps investment risk while handing longevity risk to the insurer. Accumulating means accumulation units. Receiving income means annuity units, and annuity units simply cannot exist before that conversion happens. Remember that single sentence, and most questions on this topic answer themselves. Question 19. An investor group offers to pay premiums on a policy insuring a Pennsylvania senior with no relationship to them, expecting to collect the death benefit for themselves later on. Which of the following describes the central problem with that arrangement? Your options are: it exceeds the insurer's retention limits. B. It requires an additional securities license. C. It creates a modified endowment contract. D. It lacks insurable interest at inception. Before I reveal it, which one do you think is right? The correct answer is D. It lacks insurable interest at inception. D is correct because insurable interest must exist when a policy is issued, and investors with no relationship to the insured have none. Arrangements originated for strangers are barred in most states for that reason. A is wrong because retention limits govern how much risk an insurer keeps before ceding the rest to a reinsurer. That is an internal capacity question rather than a defect in the contract. B is wrong because securities registration matters when a variable product is sold, because contract values move with separate account investments. Nothing here turns on the type of product. C is wrong because modified endowment status results from funding a policy too rapidly under a federal premium test. It changes tax treatment rather than validity, and it has nothing to do with who owns the contract. Insurance and gambling both involve money changing hands on an uncertain event, but one legal doctrine keeps them separate. That doctrine is insurable interest. A gambler creates a risk that didn't exist before the wager, while an insured transfers a risk already present in their life. Without insurable interest, a life policy becomes a bet on a stranger's death, complete with a dangerous incentive. Insurable interest exists when the applicant would genuinely suffer financially or emotionally from the insured's death. Close family ties supply it, and so do specific financial relationships. A creditor and debtor, business partners, or an employer insuring a key employee. Everyone also has unlimited insurable interest in their own life. Timing is where life insurance differs sharply from property insurance. Life insurance requires insurable interest only at issue, so a policy stays valid even after a partnership dissolves or a divorce. Property insurance requires it at the time of loss instead. Life at inception, property at loss. This inception rule is exactly what defeats stranger-originated policies, where investors with no relationship to the insured fund coverage hoping to collect. That defect exists the moment the policy is issued and nothing later fixes it. The real test is simple. If the applicant would actually be better off with the insured dead, that's precisely what the doctrine exists to prevent. Question 20. A Pennsylvania grandmother owns a policy on her grandchild and adds a rider providing that if she dies or becomes disabled, the premiums will be paid until the child reaches a stated age. Which of the following riders has she added? Your options are A. The waiver of premium rider, B. The guaranteed insurability rider, C. The pay or benefit rider, D. The accidental death rider. What's your answer? Commit to one before I continue. The correct answer is C. The pay or benefit rider. C is correct because a pay or benefit rider on a juvenile policy keeps the coverage in force by paying premiums if the adult who pays them dies or becomes disabled, usually until the child reaches a stated age. A is wrong because waiver of premium responds to the disability of the insured, and it is written when the insured and the owner are the same person. Here the child is insured and an adult pays. B is wrong because guaranteed insurability lets the owner buy additional coverage at set ages or life events without evidence of insurability. It expands protection rather than protecting the premium stream. D is wrong because an accidental death rider increases the amount payable when death results from an accident. It pays a larger claim rather than keeping a policy in force. Juvenile life insurance splits roles that normally overlap. The child is insured, but an adult owns the policy and pays every premium. The insured child pays nothing, and the paying adult isn't insured at all. If that adult dies or becomes disabled, premiums stop even though the child is perfectly healthy and insurable. The pay or benefit rider insures the funding stream itself, not the child. If the paying adult dies or becomes totally disabled, the insurer pays the premiums until the child reaches a stated age, usually the age of majority or a set year in the 20s. Waiver of premium looks similar but triggers on the insured's own disability in an ordinary adult policy. Guaranteed insurability adds coverage without new underwriting, and the accidental death rider simply pays more for accidental death. Neither touches who's funding the policy. Whenever a juvenile policy pays with an adult payor, and the trigger is that adult's death or disability, the answer is the pay or benefit rider. Question 21. A Pennsylvania consumer buys a policy that pays a lump sum on the diagnosis of one of several named conditions such as heart attack, stroke or cancer, and pays nothing for other illnesses. Which of the following describes that coverage? Your options are A. Comprehensive major medical coverage, B. A critical illness policy, C. A disability income policy, D. A long-term care policy. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B, a critical illness policy. B is correct because a critical illness or dread disease policy pays a lump sum when the insured is diagnosed with one of the specific conditions listed in the contract, and it covers nothing outside that list. A is wrong because comprehensive major medical reimburses a broad range of covered expenses after a deductible and co-insurance. Its breadth is precisely what a named condition policy lacks. C is wrong because disability income replaces earnings when the insured cannot work, and the trigger is inability to perform occupational duties rather than any particular diagnosis. D is wrong because long-term care coverage responds to a need for help with activities of daily living or to cognitive impairment. It pays for care rather than making a lump sum diagnosis payment. Medical expense coverage pays providers for treatment, but a cancer diagnosis brings a second set of costs. No medical policy touches travel to a specialized center, a spouse's unpaid leave, a mortgage that keeps coming due. Critical illness coverage exists for exactly that gap. A critical illness policy pays a lump sum when the insured is diagnosed with a specific listed condition. Heart attack, stroke, and cancer form the common core, with many contracts adding kidney failure, organ transplant, and paralysis. The payment is triggered by the diagnosis itself, and the money can be spent on anything. This design has an unusual property. Most health coverage is reimbursement-based, requiring a documented expense before payment. Critical illness instead pays on the mere occurrence of a defined event, placing it structurally closer to life insurance than to a medical policy. Sorting these products means identifying the trigger. Major medical reimburses expenses after a deductible. Disability income replaces earnings when someone can't perform occupational duties. Long-term care pays for services based on functional need or cognitive impairment, not diagnosis. Critical illness alone pays a lump sum for diagnosis of a named condition, nothing more. The narrowness of critical illness isn't a flaw, it's the design, a large payment for a small defined list of events, priced lower because the insurer's exposure is limited. Knowing whether a policy pays on diagnosis, expense, occupation, or function is what separates all four cleanly. Question 22. A Pennsylvania resident held several coverages with one life and health insurer that has now become insolvent. Which of the following states the general aggregate the guarantee association will pay for one individual arising from a single insolvency? Your options are A. $100,000, B. $250,000, C. $5 million in every case, D. $300,000 generally. Which would you go with? Lock it in before the reveal. The correct answer is D, $300,000 generally. D is correct because Pennsylvania's association caps benefits at $300,000 per individual for one insolvency, rising to $500,000 where health benefit plan coverage is involved. Component limits apply within that ceiling. A is wrong because $100,000 is the limit for net cash surrender or withdrawal value, and for other limited health coverages. It is a component limit rather than the overall cap. B is wrong because $250,000 is the present value limit the association applies to annuity contracts. Applying it as an overall aggregate would understate the protection available. C is wrong because $5 million is the ceiling for one owner holding many non-group life policies, which is a narrow situation. Treating it as the general rule would vastly overstate coverage. When a life and health insurer collapses, Pennsylvania's Guarantee Association steps in as the safety net for policyholders who paid premiums for years on a promise. The association is funded by assessments on solvent member insurers, who collectively backstop a failed one, and every licensed insurer must participate as a condition of doing business. Because it's a backstop, Agents may never advertise it as a reason to buy, since that would discourage consumers from judging a carrier's actual financial strength. Picture one ceiling for the whole person with smaller compartments inside it. The general aggregate is $300,000, rising to $500,000 where health benefit plans are involved, and it applies no matter how many contracts one resident held at the failed carrier. Inside that ceiling sit narrower component limits: $100,000 for cash surrender or limited health coverage, $250,000 for annuity present value, and a rare $5 million figure for one owner holding many non-group life policies. A claim can satisfy its component limit and still get reduced by the aggregate, since the aggregate applies after the components are calculated. The exam signal is simple. Ask whether the question is about one benefit type or one person's total exposure from one insolvency, and match it to the right figure. Question 23. A Pennsylvania lender arranges coverage on its borrowers so that if a borrower dies, the outstanding loan balance is paid off. The lender is automatically the beneficiary, and the insurance never exceeds the debt. Which of the following describes this coverage? Your options are A. Group credit life insurance, B. Survivorship life insurance, C. A key person policy, D. A juvenile policy. Don't overthink it. Which one feels right? The correct answer is A. Group credit life insurance. A is correct because group credit life insurance is sponsored by a lender, names the lender as beneficiary, and may not exceed the amount of the debt. Coverage ends when the obligation is repaid. B is wrong because survivorship life insures two people and pays only after both have died, which serves estate planning. Nothing about it retires a loan when a single borrower dies. C is wrong because a key person policy protects a business against the loss of an important employee, with the company as owner and beneficiary. The relationship here is lender and borrower. D is wrong because juvenile coverage insures a child, often with an automatic increase at a stated age. Minors do not carry the commercial debt this arrangement is built around. Lenders making thousands of loans face a quiet risk. Some borrowers will die before repaying. Group credit life insurance solves this by retiring the debt at death instead of chasing grieving families for it. The structure has 4 features that identify it on site. The lender sponsors the coverage as master policyholder. Borrowers are the insureds. The lender is automatically the beneficiary, and the insurance amount can never exceed the debt. A creditor only has insurable interest up to the size of the debt, so capping the benefit there keeps this an indemnity, not a profit opportunity. On amortizing loans, the coverage shrinks with the balance, behaving like decreasing term insurance. Survivorship life pays only at the second of 2 deaths. Wrong timing for a creditor. Key person coverage protects a business against losing an employee, not a lender against a bad debt. Juvenile coverage ensures a child who carries no commercial debt at all. The giveaway is always the same: a creditor as beneficiary, borrowers as insureds, and a benefit that never exceeds the outstanding balance. That tie between coverage and debt is the signature nothing else shares. Question 24. A Pennsylvania policy owner wants the contractual right to buy additional coverage at specified future ages and upon events such as marriage or the birth of a child without any medical questions. Which of the following riders provides that right? Your options are A. The cost of living rider, B. The guaranteed insurability rider, C. The return of premium rider, D. The waiver of premium rider. Got a guess? Lock it in. The correct answer is B. The guaranteed insurability rider. B is correct because a guaranteed insurability rider lets the owner purchase additional coverage at stated option ages and upon certain life events without evidence of insurability. with the added insurance priced at attained age. A is wrong because a cost of living rider raises the existing death benefit in step with an inflation measure. The increase is automatic rather than an option the owner exercises with new coverage. C is wrong because a return of premium rider is increasing term insurance that adds an amount equal to premiums paid to the death benefit. It rewards survival of the insured rather than expanding insurability. D is wrong because waiver of premium relieves the owner of payments while the insured is disabled. It protects the existing policy instead of granting a right to purchase more. Insurability is easy to take for granted until it disappears. A healthy woman in her 20s can buy life insurance anywhere at standard rates, but the same woman at 40, after a cardiac event or cancer diagnosis, may find coverage unavailable at any price. Her need didn't shrink, her ability to buy coverage did. The rider lets the policy owner buy additional coverage at stated option ages, or at life events like marriage, birth, or adoption without proving insurability. But it does not fix the price. Coverage is issued at the insured's attained age, so a purchase at 37 is priced as if issued to a 37-year-old. Insurers price this rider carefully because of adverse selection. Healthy people at the option date can shop the open market, while people whose health has declined are the ones most likely to exercise it. Insurers control that risk by fixing option dates in advance, capping the amount purchasable, and closing the rider at a stated age. The cost of living rider raises the death benefit automatically with inflation, no decision required, while guaranteed insurability opens a window the owner must choose to walk through or lose. Return of premium simply adds paid premiums to the death benefit, and waiver of premium keeps an existing policy in force during disability. Neither one creates new insurance the insured couldn't otherwise get. Guaranteed insurability protects against losing access to coverage, not against paying more for it. Whenever a STEM describes a right to buy more insurance later without medical evidence, that's the concept you're looking at. Question 25. Two Pennsylvania annuitants apply the same accumulated amount to a life income option on the same day, but one of them receives a noticeably larger monthly check. Which of the following combinations of factors best explains that difference? Your options are A. The producer's commission and the mode. B. The insurer's surplus and its rating. C. State of residence and premium tax. D. Age, gender, and the guarantee selected. Which one is it? Pause the video if you need more time. The correct answer is D. Age, gender, and the guarantee selected. D is correct because the size of an annuity payment depends on the annuitant's age and gender, the length of any payment guarantee, and the assumed interest rate the insurer credits to the settlement. A is wrong because commissions are built into product pricing rather than deducted from each payment, and the payment mode affects only the interval. Neither explains a materially larger check. B is wrong because an insurer's financial strength affects whether it can keep its promises, not the mathematics of an individual settlement. Two annuitants at the same company can still receive different amounts. C is wrong because state premium taxes are modest and apply at the company level. They do not produce the kind of difference that life expectancy and guarantee choices create. Two people hand an insurer the exact same amount on the same day and ask for lifetime income, yet one gets a noticeably bigger monthly check. Nothing unfair happened here. The difference comes entirely from the arithmetic of a life income calculation. Every insurer is really answering one question: over how many payments must the sum be spread? 3 inputs decide that number, life expectancy, any guarantee attached to the payout, and the assumed interest rate credited during the payout period. Picture the same fixed sum being sliced into a row of payments. The longer that row is expected to run, the thinner each slice is. The shorter it runs, the fatter each check gets. Age works the opposite of life insurance. An older annuitant gets a bigger payment because fewer payments are expected. Female annuitants with longer life expectancies as a group receive smaller payments from the same amount. Guarantees like period certain or refund options trade income for protection, and a higher assumed interest rate lifts the payment because the insurer expects to keep earning on money it still holds. So the setup of two annuitants with identical sums but different checks always traces back to age, gender, guarantee choice, and the assumed rate, never commissions, payment mode, or the insurer's surplus. The insurer is simply dividing a fixed sum across an expected number of payments. Question 26. One Pennsylvania health policy obligates the insurer to renew and forbids any premium increase, while a second obligates renewal but permits increases applied to an entire class of insureds. Which of the following correctly names these two contracts? Your options are A. Non-cancellable and guaranteed renewable. B. Guaranteed renewable and non-cancellable. C. Conditionally renewable and optionally renewable. D. Cancelable and conditionally renewable. Take a second. Which answer would you pick? The correct answer is A. Non-cancellable and guaranteed renewable. A is correct because a non-cancellable policy must be renewed and its premium can never be raised, while a guaranteed renewable policy must be renewed but permits rate increases applied to an entire class of insureds. B is wrong because reversing the two labels allows rate increases on the contract that guarantees a fixed premium. The absence of any premium change is what makes a policy non-cancellable. C is wrong because conditionally renewable coverage may be non-renewed on stated conditions such as reaching a specified age, and optionally renewable coverage may be non-renewed at the insurer's discretion on anniversary dates. D is wrong because a cancelable policy may be ended at any time, which contradicts the obligation to renew that both contracts in the question carry. Renewal is guaranteed under each description given. Health insurance renewal provisions are a 5-way vocabulary problem, and two terms at the top get reversed more than any other pair on the exam. A non-cancellable policy must be renewed and its premium can never be raised, full stop. A guaranteed renewable policy must also be renewed, but the insurer can raise rates only for an entire class, never for one expensive insured, and only with regulatory approval. Non-cancellable coverage costs more upfront because the insurer swallows all future pricing risk for decades of unknown claims. Guaranteed renewable costs less because the insured accepts exposure to class-wide increases later, and neither option is simply better. It's a real trade between paying now and paying later. The rest of the vocabulary is weaker protection. Conditionally renewable allows non-renewal only on conditions stated in advance, like reaching a certain age. Optionally, renewable allows non-renewal at the insurer's discretion on anniversary dates, and cancelable coverage can be ended any time, contradicting any renewal promise at all. Resolve the whole family with one question. Can the premium move? And if so, does it move for a class or for an individual? That single distinction separates non-cancellable from guaranteed renewable, and separates real protection from an empty promise. Question 27. A Pennsylvania applicant notes that only the insurer makes a legally enforceable promise because he is free to stop paying premium and the company cannot force him to continue paying. Which of the following contract characteristics describes that arrangement? Your options are A. An aleatory contract. B. A contract of adhesion. C. A personal contract. D. A unilateral contract. Before I reveal it, which one do you think is right? The correct answer is D. A unilateral contract. D is correct because an insurance policy is unilateral because only one party makes a legally enforceable promise. The insurer promises to pay covered claims while the policy owner never promises to keep paying premium. A is wrong because aleatory describes the unequal exchange of value, where a small premium may produce a large benefit or none at all. It concerns amounts rather than who is bound to perform. B is wrong because adhesion means one party drafts the contract and the other simply accepts or declines it, which is why ambiguity is read against the drafter. That is about bargaining power. C is wrong because a personal contract insures a particular person and generally cannot be transferred without the insurer's consent. It addresses assignability rather than mutual obligation. Insurance contracts are unusual, and contract law flags them with 4 specific traits: aleatory, adhesive, personal, and unilateral. Each one describes a completely different way the policy departs from an ordinary bargained agreement, so learning what each is really about is what keeps them from blurring together. Unilateral is about who's legally bound to perform. The insurer's promise is enforceable, the policy owner's is not. Aleatory is about the exchange of value being deliberately unequal. Adhesion is about who drafted the contract and holds the bargaining power. Personal is about whether the policy can be transferred to someone else. The unilateral structure explains what a missed premium actually is. Non-payment isn't a broken promise the insurer can sue over, because the policy owner never made one. It's simply a failure of the condition the insurer's obligation depended on, so coverage ends, subject to grace periods and reinstatement provisions. Each trait has its own giveaway language. One party bound while the other is free points to unilateral. A wildly unequal exchange of value points to aleatory. Take it or leave it drafting points to adhesion. And restrictions on handing the policy to someone else point to personal. 4 characteristics, 4 entirely distinct subjects. Reading the stem for which subject it's actually raising does most of the work on exam day. Question 28. A Pennsylvania beneficiary is hospitalized well beyond the days Medicare covers in full within a benefit period, and she asks what she owes for the remaining covered days. Which of the following describes Part A, hospital cost sharing? Your options are: A. The beneficiary owes nothing after the deductible. B. Daily co-payments apply after 60 days. C. Coverage stops entirely after the deductible. D. The beneficiary pays 1/5. What's your answer? Commit to one before I continue. The correct answer is B. Daily co-payments apply after 60 days. B is correct because after the Part A deductible, Medicare pays the first 60 days of a hospital stay in full. Days 61 through 90 carry a daily co-payment, and lifetime reserve days carry a higher one. A is wrong because full coverage for an unlimited stay would leave Medicare exposed without any cost sharing. Part A pays in full only for the opening stretch of each benefit period. C is wrong because coverage does not end when the deductible is satisfied. That payment is what opens the benefit. Days remain covered subject to co-payments until the benefit period limits are reached. D is wrong because percentage co-insurance of that kind belongs to Part B, which pays about 80% of approved charges. Part A uses flat daily amounts instead. Medicare Part A runs on a structure unlike anything most people have seen before, built around benefit periods instead of a calendar year. A benefit period starts when you're admitted as an inpatient and ends after 60 straight days out of a hospital or skilled nursing facility. So you can pass through several benefit periods, each with its own deductible in a single year. Inside one benefit period, coverage moves through clear stages. The deductible opens the benefit, then Medicare covers the first 60 days in full. Days 61 through 90 carry a daily co-payment, and beyond that, lifetime reserve days kick in at a higher rate, capped at 60 days for your entire life. The deductible is the most misunderstood piece, and the confusion runs both ways. Some assume it's annual. It's not, since it resets with every benefit period. Others assume paying it ends coverage. when really it opens the benefit, and days remain covered under the co-payment schedule afterward. Keeping Part A and Part B separate matters because test questions exploit the overlap. Part A uses flat daily dollar amounts tied to a benefit period, while Part B uses percentage coinsurance, generally paying about 80% after an annual deductible, and that annual deductible belongs to Part B, not Part A. Recognize the sequence: deductible first, then 60 days fully covered, then daily co-payments through day 90, then lifetime reserve days at a higher rate. The moment a question mentions physician services, outpatient care, or a percentage, you've shifted to Part B. Question 29. A Pennsylvania producer recommending an annuity must give the consumer a form describing the scope of her authority, the products she can sell, and how she is compensated. Which of the following best interest obligations does that form satisfy? Your options are: A, the disclosure obligation; B, the care obligation; C, the documentation obligation; D, the conflict of interest obligation. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A, the disclosure obligation. A is correct because the disclosure obligation requires the producer to give the consumer a form describing the scope of her authority, the product she may sell, and the sources and types of cash and non-cash compensation. B is wrong because the care obligation requires reasonable diligence and a reasonable basis for the recommendation after learning the consumer's financial situation, needs, and objectives. It governs analysis rather than paperwork. C is wrong because the documentation obligation requires a written record of the recommendation and its basis, which the producer keeps in her own file. It memorializes advice rather than informing the consumer. D is wrong because the conflict of interest obligation requires identifying and avoiding or managing material conflicts. Ordinary compensation is expressly not treated as a material conflict under the article. Annuity regulation shifted from a suitability standard to a best interest standard, and Pennsylvania adopted a model built around 4 separate obligations a producer owes when recommending an annuity. The 4 obligations are care, disclosure, conflict of interest, and documentation. They are cumulative, not alternative, so satisfying one never excuses another, and each targets a different failure mode. Disclosure requires a written form given to the consumer describing the producer's scope of authority, the product she may sell, and her compensation. Documentation, by contrast, is a written record kept in the producer's own file so a regulator can later reconstruct why the recommendation was made. Care is about analysis, gathering the consumer's financial picture and having a reasonable basis for the recommendation, not paperwork. Conflict of interest requires managing material conflicts, but ordinary sales commissions are expressly excluded and routed through disclosure instead. When a STEM mentions gathering financial information, think care. A form given to the consumer signals disclosure. A record kept in the file is documentation. And managing a conflict, remembering that ordinary commissions don't count, is conflict of interest. Question 30. A Pennsylvania producer is deployed on active military service overseas and cannot possibly complete her continuing education before her 2-year license period ends. Which of the following describes the relief the department may provide in that particular situation? Your options are: A, automatic revocation with later reapplication; B, doubling of the next period's requirement; C, a waiver of education and renewal requirements; D, nothing because deadlines are absolute. Which would you go with? Lock it in before the reveal. The correct answer is C, a waiver of education and renewal requirements. C is correct because Pennsylvania gives the department limited authority to waive continuing education and renewal requirements for military service or other documented extenuating circumstances. So a deployed producer does not lose her license. A is wrong because revoking the license of a producer serving on active duty would penalize military service. The Commonwealth chose the opposite approach by building a waiver into the statute. B is wrong because no doubling provision exists, and carry forward credits move in the other direction by letting surplus hours count toward a later period. Piling on hours is not the statutory remedy. D is wrong because treating deadlines as absolute would ignore the express waiver authority the licensing article grants. The department may act on documented extenuating circumstances, and the statute contemplates exactly this one. When a licensed producer can't complete continuing education for reasons entirely outside her control, Pennsylvania's licensing statute has a built-in answer. Understanding why that answer exists tells you exactly when it applies and when it doesn't. The relief is discretionary, not automatic. The producer requests it, supplies documentation, and the department evaluates the situation with military deployment specifically contemplated by the statute. Continuing education exists, so producers stay current for consumers, not as an end in itself. Stripping a license from someone who couldn't comply for reasons unrelated to willingness or competence protects no one and only punishes someone performing a public service. The category reaches beyond military service to serious illness, disability, and other documented situations where compliance was genuinely impossible. A producer who simply ran out of time has not shown an extenuating circumstance because the department's authority is limited, not a general power to forgive deadlines. Doubling future requirements or revoking the license outright isn't the structure the legislature chose. Excess credits carry forward, waivers apply to genuine impossibility, and that distinction is exactly what a well-written STEM is testing. Question 31. A Pennsylvania disability policy pays benefits only for injuries and illnesses that arise away from the job, on the theory that on-the-job losses are covered elsewhere. Which of the following describes that policy and the other coverage assumed? Your options are A. Non-occupational, workers' compensation covers the job. B. Occupational, Medicare covers the job. C. Non-occupational, Medicaid covers the job. D. Occupational, group life covers the job. Don't overthink it. Which one feels right? The correct answer is A. Non-occupational, workers' compensation covers the job. A is correct because a non-occupational disability policy excludes losses arising out of employment because workers' compensation covers those losses. Occupational coverage, by contrast, pays whether the disability began on or off the job. B is wrong because occupational coverage would include job-related losses rather than excluding them, and Medicare pays medical bills for the aged and disabled rather than replacing wages after a workplace injury. C is wrong because Medicaid is a needs-based medical program and provides no wage replacement for workplace injuries. Naming it as the job-related backstop misidentifies the system that covers those losses. D is wrong because group life pays a death benefit and does nothing for a living employee unable to work. Labeling the policy occupational also contradicts the exclusion described. Disability coverage in the United States splits between two separate systems, and knowing where each one stops is the key to answering these questions correctly. Workers' compensation, a state-mandated employer-funded program, handles injuries arising out of employment. A non-occupational policy fills in the rest, paying only for off-the-job losses. Occupational coverage pays regardless of where the disability happened, which costs more because the insurer accepts broader risk. Workers' compensation itself runs on a trade called the exclusive remedy. The employee recovers without proving fault, but gives up the right to sue the employer. In exchange, they receive medical treatment, partial wage replacement, and payments for permanent impairment, though that wage replacement is only partial. For a salaried employee already backed by workers' compensation, the cheaper non-occupational policy is sound advice. But self-employed individuals, business owners, independent contractors, and workers excluded from workers' compensation have no state program behind on-the-job injuries, so that same policy leaves them with a genuine hole. When a policy excludes work-related loss, workers' compensation is the system standing behind that gap. Read for whether the job is in or out, then name the other system covering it. Question 32. A Pennsylvania producer soliciting individual life insurance must deliver documents that let the buyer compare cost and understand the contract, including a comparison index disclosure. Which of the following identifies the chapter obligations that apply to that solicitation? Your options are A. Standards for claim acknowledgement and denial. B. Rules governing viatical settlement providers. C. Minimum benefit standards for senior products. D. Disclosure statement and surrender comparison index requirements. Got a guess? Lock it in. The correct answer is D. Disclosure statement and surrender comparison index requirements. D is correct because Pennsylvania's solicitation chapter requires delivery of a disclosure statement or policy summary in individual life sales, together with a life insurance surrender comparison index disclosure that helps buyers compare cost. A is wrong because acknowledgement and denial deadlines come from the unfair claim settlement regulation and apply after a loss. They govern claim handling rather than what a buyer receives at solicitation. B is wrong because viatical settlement provider rules govern the purchase of existing policies from their owners. Those requirements apply to a sale of coverage already in force rather than to a new solicitation. C is wrong because minimum benefit standards for Medicare supplement and long-term care coverage set what senior products must include. They do not supply the cost comparison documents described here. Comparing two life insurance policies is genuinely hard, and that's not the buyer's fault. Premiums differ. Cash values grow at different rates, dividends vary, and $1 paid today isn't worth the same as $1 paid in 20 years. Pennsylvania's solicitation rules require a producer to deliver two things: a disclosure statement or policy summary describing the actual contract, and a surrender cost comparison index. One explains the product, the other makes it comparable to alternatives. The index applies time value of money to the stream of premiums, dividends, and cash values a policy generates, reducing them to one comparable figure. It assumes surrender at a stated point and measures net cost on that assumption. Imperfect, since it relies on non-guaranteed illustrated values, but a common yardstick beats none. Each product line has its own document set. Life solicitation uses the disclosure statement and cost index. Long-term care uses an outline of coverage and shopper's guide, and Medicare supplement uses its own outline and buyer's guide. Claim deadlines, viatical rules, and minimum benefit standards live in entirely different chapters. These documents are required at solicitation, not delivery, because information after a decision helps nobody. Comparison material must reach the buyer while she still has choices, which is exactly why the free look period exists as a second safety net. Question 33. A Pennsylvania applicant with a chronic knee condition is offered health coverage that excludes any treatment related to that knee while covering everything else the policy normally covers. Which of the following describes the document producing that result? Your options are A. An impairment rider, B. A stop-loss provision, C. A co-insurance schedule, D. A conformity endorsement. Which one is it? Pause the video if you need more time. The correct answer is A. An impairment rider. A is correct because an impairment rider attaches to a health policy and excludes a specific named condition from coverage, letting the insurer issue a contract it would otherwise decline while the rest of the coverage stays intact. B is wrong because a stop-loss provision ends the insured's cost sharing once out-of-pocket spending reaches a stated amount. It limits what a person pays rather than removing a condition from coverage. C is wrong because a coinsurance schedule sets the percentages the plan and the insured each pay for covered charges. It divides cost on covered items instead of designating something as uncovered. D is wrong because a conformity endorsement brings policy language into agreement with the law of the insured's state. It corrects wording rather than carving out a medical condition. An underwriter facing a real but narrow health impairment doesn't have to choose between accepting full risk or declining the applicant entirely. Health underwriting created a third option. An impairment rider attaches to a policy and carves out one named condition or body part, while everything else stays covered. It lets an insurer say yes to an applicant it would otherwise have to turn down. Picture a policy covering the full range of ordinary claims, with one carved out zone naming the excluded condition. The applicant gets real protection everywhere else, but carries the entire financial exposure for the one condition she already knows she has. 3 other provisions get confused with this one, but they do entirely different jobs. Stop-loss limits what the insured pays out of pocket. Coinsurance divides cost on covered charges between plan and insured. And a conformity endorsement just corrects wording to match state law. Only the impairment rider removes a condition from coverage altogether. Precision in drafting matters, since a narrow exclusion behaves very differently from a broad one. Federal reform pushed impairment riders out of major medical, but they still operate in disability income, long-term care, and supplemental health. Question 34. A Pennsylvania policy owner adds temporary coverage on her husband and on all of her children to her own permanent policy, rather than buying separate contracts for each of them. Which of the following describes what she has added? Your options are A. A guaranteed insurability rider. B. An accelerated benefit provision. C. Spouse and children term riders. D. A pay or benefit rider. Take a second. Which answer would you pick? The correct answer is C. Spouse and children term riders. C is correct because riders covering additional insureds add term coverage on a spouse, children, or the whole family to a base policy, usually at a lower cost than separate contracts and for a limited period. A is wrong because a guaranteed insurability rider lets the owner buy more coverage on the insured at stated ages without medical questions. It adds nothing on any other person's life. B is wrong because an accelerated benefit provision advances part of the death benefit to the insured during life on certification of a qualifying condition. It changes when money is paid rather than who is covered. D is wrong because a pay or benefit keeps a juvenile policy in force when the adult paying premium dies or becomes disabled. It protects the premium stream rather than insuring family members. Instead of buying separate policies for a spouse and children, a policy owner can attach riders to a policy she already owns, adding coverage on other lives through one contract. A spouse rider, also called an other insured rider, adds term coverage on the husband or wife. A children's rider covers all children under one charge, even those born or adopted later with no extra underwriting. A family rider simply bundles both together. The most valuable feature is conversion. Most children's riders let the child convert to a permanent policy at a stated age, often in their 20s without proving insurability. A child who develops a serious health condition still keeps a path to permanent coverage, guaranteed for just a few dollars a month. Other riders sound similar but work differently. Guaranteed insurability adds more coverage on the same insured later without medical questions. An accelerated benefit pays part of the death benefit early. A pay-or benefit keeps a juvenile policy in force if the paying adult dies or becomes disabled. None of these add coverage on another life. Whenever a question describes coverage, add it on someone other than the base insured, especially a spouse or children. Think riders on an existing policy, not new policies. Question 35. A Pennsylvania insured holds expense-incurred health coverage with two different companies and files the same hospital bill with both of them. Which of the following describes how the optional provision governing insurance with other insurers handles that claim? Your options are: A. The first company notified pays everything. B. Both companies pay the claim in full. C. Neither pays until the insured chooses one. D. Each insurer pays a proportionate share. Before I reveal it, which one do you think is right? The correct answer is D. Each insurer pays a proportionate share. D is correct because the insurance with other insurers provision prorates expense incurred benefits among the companies covering the same loss, and any premium collected for the excess coverage is returned to the insured. A is wrong because rewarding whichever insurer heard first would turn claim handling into a race and would leave that company bearing a loss that others also insured. Proration spreads it instead. B is wrong because paying twice would let an insured profit from a single hospital bill, which the principle of indemnity forbids. Expense incurred coverage reimburses actual cost rather than multiplying it. C is wrong because leaving the choice to the insured would still leave one insurer paying everything while the other paid nothing despite collecting premium. The provision divides responsibility by formula. Indemnity means an insured is restored to their prior position after a loss, never better off than before. Health insurance enforces this when two policies cover the same expense, since a person could otherwise submit one bill to both companies and collect twice. The insurance with other insurers provision prorates benefits among the companies rather than paying each in full, and it refunds premium the insured paid for coverage that turned out to be excess. Proration on the claim, refund on the premium, both parts of the same rule. Picture one hospital bill sent to two insurers. Instead of each paying in full, each pays a prorated share so the total equals the bill exactly, and any premium collected for coverage that was never needed flows back to the insured. Paying whoever gets notified first turns claims into a race. Both paying in full lets the insured profit, which indemnity forbids. Letting the insured choose still leaves one insurer paying everything, while the other keeps premium for nothing. Proration is the only approach that avoids all three problems. When the question describes an individual expense incurred policy with the same bill filed twice, think proration and premium refund. When it describes group plans asking which pays first, that's coordination of benefits and order of benefit rules instead. Question 36. A Pennsylvania producer meets a prospect to discuss long-term care coverage and must supply printed material describing the policy's benefits, along with a general consumer publication about this kind of insurance. Which of the following names those two documents? Your options are A policy summary and a delivery receipt. B, a buyer's guide and a replacement notice. C, an outline of coverage and shopper's guide. D, a conditional receipt and a disclosure statement. What's your answer? Commit to one before I continue. The correct answer is C, an outline of coverage and shopper's guide. C is correct because Pennsylvania long-term care rules require delivery of an outline of coverage describing the policy's benefits and limitations, together with a shopper's guide that explains long-term care insurance generally. A is wrong because a policy summary is a life insurance solicitation document and a delivery receipt records when a policy reached the owner. Neither is the pair required in a long-term care sale. B is wrong because a buyer's guide is the consumer publication required in Medicare supplement sales, and a replacement notice is needed only when existing coverage will be displaced. D is wrong because a conditional receipt creates interim coverage when premium accompanies a life application, and a disclosure statement belongs to the life solicitation chapter. Neither applies here. Pennsylvania requires disclosure documents in several insurance lines, and each line has its own matched pair. Exam writers love this because the documents perform parallel jobs under different names. So sorting them by line of business isn't optional. It's the entire task. Long-term care sales require 2 documents delivered at or before solicitation. The outline of coverage describes the specific policy's benefits, limitations, and exclusions, while the shopper's guide explains how long-term care insurance works in general. One document is about the policy, the other is about the category. Long-term care disclosure carries extra weight because of who buys it. Purchasers are often older, the contracts are expensive, benefit triggers are technical, and the decision frequently happens under emotional pressure. Standardized documents let a buyer compare contracts without depending on how a producer describes them. Other lines have their own look-alike pairs. Medicare Supplement uses a buyer's guide alongside its own outline of coverage. Life insurance pairs a policy summary with the surrender cost comparison index. A replacement notice is transaction triggered, not line specific, and delivery receipts or conditional receipts aren't disclosure documents at all. The pattern always repeats generic education about the product class, plus specific disclosure about the contract in hand. Learn each pair by line of business, and the exam's mismatched document traps stop working. Question 37. A Pennsylvania buyer wants a flexible premium permanent policy whose cash account earns interest tied to the performance of a stock market index, while the insurer still guarantees the account value. Which of the following products fits her request? Your options are A. Variable universal life insurance, B. Indexed universal life insurance, C. Variable life insurance, D. Annually renewable term insurance. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Indexed universal life insurance. B is correct because indexed universal life keeps the flexible premium and cash account structure of universal life while crediting current interest linked to a market index, and the insurer still guarantees the account. A is wrong because variable universal life places cash value in a separate account where the owner bears investment risk and no guarantee applies. The guarantee described here is exactly what that product lacks. C is wrong because variable life puts the policy's savings element into sub-accounts that the owner selects, and it does provide a guaranteed minimum death benefit, but its premium is fixed rather than flexible. 2 features fail to match. D is wrong because annually renewable term builds no cash value and credits no interest at all. It provides pure protection with a premium that rises each year with attained age. Universal Life took the permanent policy apart, separating premium, the cost of insurance, and interest crediting into pieces that could move independently. Once unbundled, how the cash account earns interest became a design choice, and those choices created an entire family of products. In its original form, Universal Life credits a current rate declared by the insurer, backed by a guaranteed floor, with cash value held in the general account. The owner gets flexible premiums and an adjustable death benefit, while the insurer bears the investment risk. Indexed Universal Life keeps that same structure, but changes how interest is credited, linking it to a market index instead of a declared rate. The insurer isn't investing in the index. it credits interest by a formula shaped by a participation rate, a cap and a floor, commonly 0, so the account never loses value from index performance. Variable universal life makes the opposite choice, moving cash value into sub-accounts the owner selects with no guarantee, offering more growth potential and real loss potential. Variable life sits in between, using sub-accounts but keeping a fixed premium and a guaranteed minimum death benefit. An annually renewable term builds no cash value at all. Identify each product by its structure. A declared rate with a guaranteed floor is plain universal life. An index-linked formula with a guarantee is indexed universal life. Owner-borne risk with no guarantee is variable universal life. And sub-accounts paired with a fixed premium is variable life. Question 38. An insurer reviewing its results notices that applicants who expect to file claims apply far more readily than healthy applicants do, which pushes actual claims above what the rates assumed. Which of the following best names that tendency? Your options are A. The law of large numbers, B. Reinsurance recapture, C. Moral hazard, D. Adverse selection. Which would you go with? Lock it in before the reveal. The correct answer is D. Adverse selection. D is correct because adverse selection is the tendency of risks with a greater than average chance of loss to seek insurance more actively than better risks, which drives actual claims above the level rates anticipated. A is wrong because the law of large numbers says that predictions improve as the number of similar exposures grows. It explains why insurance works rather than describing a threat to pricing. B is wrong because recapture describes a ceding insurer taking back business previously placed with a reinsurer. That is a contractual arrangement between companies rather than a pattern among applicants. C is wrong because moral hazard is a dishonest tendency, meaning a willingness to cause or exaggerate a loss to collect. It describes character rather than who chooses to apply for coverage. Insurance rates only work if the people who buy coverage look like the population the rates were built from. Adverse selection is what happens when riskier people seek coverage more eagerly than healthier people do, breaking that assumption. The mechanism is information. An applicant knows her own health, habits, and family history far better than any carrier can discover, and she acts on that knowledge. So, riskier applicants disproportionately fill the pool. Left unchecked, the process compounds. Higher claims force higher rates. Higher rates push the healthiest people to drop coverage first, and their exit worsens the remaining pool, forcing rates even higher. Insurance economists call this a death spiral. Nearly every underwriting and contractual tool exists to fight adverse selection. Medical underwriting screens applicants. Pre-existing condition provisions limit new claims. Probationary periods delay coverage. And open enrollment windows restrict when people may join. Adverse selection is about who chooses to apply. Keep it distinct from the law of large numbers, which explains why insurance works, and from moral hazard, which is dishonest behavior rather than a selection problem. Question 39. A Pennsylvania individual health policy states that any sickness beginning during the first 30 days after issue will not be covered, although accidental injuries are covered immediately from the effective date. Which of the following names that opening period? Your options are A. The elimination period, B. The probationary period, C. The grace period, D. The free look period. Don't overthink it. Which one feels right? The correct answer is B. The probationary period. B is correct because a probationary period at the start of a health policy delays coverage for sickness that begins during the opening weeks, while an accidental injury is generally covered from the effective date. A is wrong because an elimination period is the waiting time after a covered disability begins and before benefits are payable. It applies to each claim rather than only to the start of the contract. C is wrong because a grace period gives the policy owner extra time to pay an overdue premium without the policy lapsing. It protects the contract rather than restricting what is covered. D is wrong because a free look lets the buyer return a newly delivered policy for a full refund. It is a consumer right during the opening days rather than a coverage restriction. Health insurance loves the word period, and 4 of them get confused constantly: probationary, elimination, grace, and free look. The trick to telling them apart is simple. Ask what event starts the clock. A probationary period starts at the policy's effective date and delays coverage only for sickness, while accidents are covered immediately. An elimination period starts when a covered disability begins, and it applies to every claim in year 1 or year 15. A grace period starts when a premium is overdue, and a free look period starts when the new policy is delivered. This asymmetry exists because accidents are sudden and hard to fake, but sickness develops slowly, so someone already feeling symptoms could buy a policy and file a claim right away. The probationary period closes that window, making sure an early illness wasn't already brewing before the applicant signed up. The elimination period works like a deductible measured in days rather than dollars, and choosing a longer one lowers premium because it cuts out the most frequent short claims. Grace and free look periods aren't restrictions at all. They protect the insured, one against a missed payment, the other against a purchase they want to undo. Sickness delayed at the start means probationary. Waiting after a disability begins means elimination. Extra time for a late premium means grace. Returning a new policy for a refund means free look. Find the trigger and the period names itself. Question 40. A Pennsylvania life policy states that no death benefit is payable if the insured dies in an aircraft accident, and the producer explains the one situation the exclusion does not reach. Which of the following describes that situation? Your options are A fare-paying passenger on a commercial flight, B, a student pilot on a training flight, C, a military pilot on a routine mission, D, the owner of a private aircraft. Got a guess? Lock it in. The correct answer is A, a fare-paying passenger on a commercial flight. All is correct because aviation exclusions in life policies reach private and military flying, but do not apply when the insured is a fare-paying passenger or crew member on a scheduled commercial airline. B is wrong because student pilots are exactly the exposure and aviation exclusion targets, since training flights carry elevated risk. The clause applies with full force to that situation. C is wrong because military flying is among the riskiest aviation activity and is commonly excluded outright, often alongside a separate war or military service clause. Nothing in the clause spares it. D is wrong because flying one's own aircraft is private aviation, which the exclusion covers. Ownership does not convert the activity into commercial passenger travel, and the exception is written for paying passengers. A life insurer that promised to pay for every death under every circumstance would have to price coverage for risks most people never take. Exclusions keep ordinary policies affordable by carving out activities riskier than standard mortality assumes, and aviation is the classic example. An aviation exclusion denies the death benefit for accidents in private and military flying. That includes piloting a personal aircraft, training as a student, crop dusting or experimental aircraft, and military aviation. The reasoning is measured risk, not generosity. Scheduled commercial flights operate under strict federal regulation of maintenance, training, and procedures, giving them an extraordinary safety record and negligible added risk, while general and military aviation carry accident rates far higher. Insurers have 3 ways to handle aviation risk: charge an extra premium reflecting the added mortality, attach an exclusion rider, or decline coverage altogether. The exclusion is the middle path, covering every cause of death except the one activity the insurer won't price. The exception follows the operation, not the seat. A fare-paying passenger or crew member on a scheduled commercial airline is covered, but private piloting, student instruction, and military flying stay inside the exclusion, no matter who owns the plane. Question 41. A young Pennsylvania couple with 2 small children buys life insurance so that if either parent dies, the surviving family will have income to replace the earnings that were lost. Which of the following personal uses of life insurance does this illustrate? Your options are A. Estate conservation, B. Business continuation, C. Survivor protection, D. Executive compensation. Which one is it? Pause the video if you need more time. The correct answer is C. Survivor protection. C is correct because survivor protection is the use of life insurance to replace the income a family loses when a wage earner dies, so dependents can maintain their standard of living. A is wrong because estate conservation protects accumulated wealth from erosion by taxes and settlement costs. It matters most to families with substantial assets rather than young earners with dependents. B is wrong because business continuation funds the orderly transfer of a company interest when an owner dies. Nothing in this couple's situation involves a business or its ownership. D is wrong because executive compensation uses insurance to reward or retain key employees. It is an employer benefit strategy rather than a family income replacement plan. Life insurance exams expect you to sort real-world situations into recognizable categories. Getting there fast means asking one question: whose loss is being covered and what is the money replacing? Personal uses include survivor protection, estate creation, estate conservation, cash accumulation, and final expenses. Business uses include business continuation, key person coverage, and executive compensation. Matching a fact pattern to the right category is the actual skill being tested. Survivor protection replaces income a family loses when a wage earner dies. To size the need. The human life value approach estimates future earnings, while the needs approach adds up specific obligations like final expenses, debt, income, education, and a spousal fund. Running both gives a defensible range rather than a single guess. The boundary worth knowing separates survivor protection from estate conservation. One replaces a paycheck that stopped for a young family relying on earnings. The other protects wealth already built, supplying liquidity so heirs don't have to sell assets to cover taxes and settlement costs. A family needing replaced income points to survivor protection. Large assets and tax worries point to estate conservation. A business needing transfer points to continuation. An employer rewarding a key person points to executive compensation. Identify the loss and the category follows. Question 42. A Pennsylvania woman with dense breast tissue is told she needs a supplemental screening beyond her routine mammogram, and she asks her producer whether any cost sharing will apply to it. Which of the following describes the Commonwealth's current requirement? Your options are A. All costs covered plus genetic counseling, B. Covered only after the annual deductible, C. Covered at half the allowed charge, D. Not covered outside a hospital setting. Take a second. Which answer would you pick? The correct answer is A. All costs covered plus genetic counseling. A is correct because Pennsylvania requires covered entities to pay all costs associated with one annual supplemental breast screening for individuals at increased risk, including dense breast tissue and all costs of genetic counseling and indicated testing. B is wrong because applying a deductible would leave the very cost barrier the statute removed. The requirement reaches all costs associated with the screening rather than making it a deductible, eligible service. C is wrong because partial coverage would reintroduce cost sharing on a benefit the legislature made cost-free. Nothing in the amendment splits the charge between plan and patient. D is wrong because no setting restriction appears in the mandate, and supplemental screening is often performed at imaging centers. Limiting it to hospitals would narrow a benefit written broadly. Mammography works by spotting contrast between dense tissue and fat, but in women with uniformly dense breasts, that contrast disappears. Tumors and dense tissue both show up white, so the exam most likely to save her life becomes the exam least likely to work. On the image, a tumor sitting inside dense tissue looks nearly identical to the tissue around it, which is exactly why supplemental imaging like ultrasound or MRI is needed to find what the mammogram missed. Pennsylvania requires covered entities to pay all costs of one annual supplemental screening for those at increased risk, plus all costs of genetic counseling and any indicated testing. The operative phrase is all costs, not a deductible, not a percentage. Any deductible reintroduces the exact cost barrier the law eliminated. Splitting the charge between plan and patient still leaves a cost the mandate removed. And restricting coverage to hospitals ignores that most supplemental screening happens at freestanding imaging centers. A covered benefit only works if patients actually use it, and cost sharing is what stopped them. That's why this mandate, and mandates like it, remove the barrier entirely rather than just nominally requiring coverage. Question 43. A Pennsylvania employer pays the entire premium for group term life coverage on its employees, and one employee's amount of coverage substantially exceeds the federal threshold. Which of the following describes the tax consequence to that particular employee? Your options are: A. The entire premium becomes taxable income. B. The death benefit becomes taxable. C. Cost of coverage above the threshold. D. Nothing is taxable because the employer paid. Before I reveal it, which one do you think is right? The correct answer is C. Cost of coverage above the threshold. C is correct because employer-paid group term life premium is deductible to the employer, and the cost of coverage exceeding $50,000 is reported as taxable income to the employee. The death benefit itself remains income tax-free. A is wrong because taxing the whole premium would ignore the exclusion Congress provided for the first layer of employer-paid coverage. Only the cost attributable to the excess is included. B is wrong because group life-death proceeds retain the same income tax exclusion that applies to individual life insurance. The threshold rule affects the employee during life rather than the beneficiary later. D is wrong because employer payment is what triggers the rule rather than avoiding it. When an employee pays for the coverage personally, no imputed income arises at all. Group term life insurance runs on a tax bargain. The employer deducts the premium, the employee usually pays no tax on it, and their death benefit reaches the beneficiary tax-free. Congress placed a boundary on that middle piece, and that boundary is what this question really tests. There are three favorable outcomes at once. The employer deducts the premium as a business expense. The employee generally receives the benefit tax-free, and the death benefit reaches the beneficiary income tax-free. The line sits at $50,000. Coverage up to that amount is excluded from the employee's income, but the cost of coverage above it becomes imputed income. Calculated not from the actual premium but from a federal table of uniform rates based on the employee's age. Two boundaries matter here. The death benefit itself keeps its tax exclusion no matter the coverage amount, since imputed income only affects the employee during life, and employer payment is what triggers the rule at all. When the employee pays with after-tax dollars, there's no employer-provided benefit to impute. Expect employer-paid coverage above $50,000 paired with a question about the employee's tax consequence. The excess is imputed income from the federal table. The death benefit stays tax-free, and employee-paid coverage triggers nothing at all. Question 44. A Pennsylvania buyer wants term coverage that refunds the premium she paid if she is still living when the term ends, and she accepts a higher premium in exchange for that feature. Which of the following products is she describing? Your options are A. Decreasing term insurance, B. Return of premium term insurance, C. Single premium whole life insurance, D. An equity indexed annuity. What's your answer? Commit to one before I continue. The correct answer is B. Return of premium term insurance. B is correct because return of premium term insurance costs more than ordinary term and refunds the premiums the insured paid if she survives to the end of the term, combining protection with the savings feature. A is wrong because decreasing term reduces the face amount over the term while holding the premium level, and it refunds nothing at expiration. It is designed to track a shrinking debt. C is wrong because single premium whole life is permanent coverage, bought with one payment and carries immediate cash value. It never expires, so there is no term end at which premiums are returned. D is wrong because an equity index annuity accumulates retirement money with interest tied to a market index and provides no death benefit measured by a face amount of insurance. Return of premium term was built to fix term insurance's biggest objection, surviving the term and getting nothing back. But that guarantee has a cost, and understanding it teaches a bigger lesson about insurance design. Structurally, this product is ordinary level term with a savings account attached. If you die, your beneficiary gets the death benefit. If you survive, you get your premiums back tax-free because it's simply your own money returning to you, not a gain. That refund isn't a bonus from the insurer. The insurer collects extra premium upfront, invests it, and simply hands back what was paid in at the end. Whether that's worthwhile depends entirely on the buyer's discipline to save the difference herself. Decreasing term shrinks the face amount and refunds nothing, since it tracks a falling debt. Single premium whole life is permanent coverage bought with one payment, so there's no term end for a refund. An equity indexed annuity builds retirement savings but carries no death benefit at all. The catch most buyers miss is surrender. Cancel early, and you only get a small scheduled fraction back, not years of premiums. The refund rewards persistence, so it suits a disciplined saver far more than someone whose plans might change. Question 45. A Pennsylvania employer offers two disability plans. One replaces income for a few months after a short waiting period, and the other begins later and continues for years. Which of the following correctly names these two plans in that order? Your options are A. Occupational and non-occupational disability, B. Presumptive and residual disability, C. Business overhead and key person coverage, D. Short-term and long-term disability. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Short-term and long-term disability. D is correct because group short-term disability begins after a brief waiting period and pays for a limited number of weeks or months, while group long-term disability starts later and can continue for years. A is wrong because occupational and non-occupational describe whether job-related losses are covered. That distinction concerns the cause of disability rather than how long benefits last, since duration is a separate question. B is wrong because presumptive disability qualifies an insured automatically after catastrophic loss, and residual disability measures a reduction in earnings. Neither describes the duration of a plan. C is wrong because business overhead expense reimburses a practice's fixed costs, and key person coverage indemnifies an employer. Both protect a business rather than replacing an employee's income. Disability coverage is built in layers because the cost of not working changes shape over time. A short absence is a cash flow problem. A long one is a catastrophe. Employers typically use two separate plans to match each risk. Short-term disability begins almost immediately and pays for a limited span. Bridging the interruption, most claims resolve within. Long-term disability picks up where short-term ends, with an elimination period of 90 or 180 days continuing for years. The design point is coordination. The long-term plan's waiting period is set to match exactly when short-term benefits run out, so an employee moves from one to the other without a gap in income. Two features of long-term plans often surprise claimants. The disability definition frequently shifts from own occupation to any occupation around the 2-year mark, and benefits are integrated with sources like Social Security, so the plan pays only the difference rather than stacking on top. The pattern to recognize: short-term begins quickly and pays briefly. Long-term begins later and pays for years. Distinct questions about job-related causes, automatic qualification, or business protection point to different terms entirely. Question 46. A Pennsylvania producer under investigation reaches a negotiated settlement with the insurance department that resolves the matter without a contested hearing, and both sides sign it and agree to its terms. Which of the following describes that document? Your options are A cease and desist order, B, a consent agreement, C, a certificate of authority, D, a notice of appointment termination. Which would you go with? Lock it in before the reveal. The correct answer is B, a consent agreement. B is correct because a consent agreement resolves most producer enforcement matters in Pennsylvania. The licensee and the department negotiate terms, which may include penalties or license conditions, and no contested hearing is needed. A is wrong because a cease and desist order is issued by the commissioner, typically after a hearing, directing a person to stop conduct. It is imposed rather than negotiated between the parties. C is wrong because a certificate of authority is the license an insurance company holds to transact business in the Commonwealth. It concerns companies rather than producer discipline. D is wrong because an appointment termination notice is filed by an insurer ending a producer's authority to represent it. That is a company filing rather than a resolution of a department investigation. Regulatory enforcement rarely ends in a dramatic hearing. Most producer enforcement matters in Pennsylvania end the way most disputes end, by agreement. A consent agreement is negotiated and signed by both the licensee and the department, resolving a matter without a contested hearing. Its terms may include a civil penalty, conditions like supervision or education, a suspension or surrender of the license. The mutual nature of the document is its defining feature. The producer gains certainty and avoids the cost of a contested proceeding, while the department secures a resolution and compliance conditions it can enforce. That reporting consequence is what producers most often underestimate. A consent agreement is reportable to other states, appears in the National Producer Database, and must be disclosed on future applications and appointment paperwork, because reciprocal reporting was built into the system deliberately. Each alternative belongs to a different situation. A cease and desist order is imposed rather than negotiated. A certificate of authority concerns a company's right to transact business, and an appointment termination is an insurer's filing, not a department resolution. Only the consent agreement is the signed negotiated settlement between producer and department. Question 47. A Pennsylvania long-term care applicant received treatment for a condition several months before her policy took effect, and she asks how long the insurer may look back and how long it may exclude that condition. Which of the following states both limits? Your options are A 12-month look-back and 12-month exclusion. B, a 2-year look-back and permanent exclusion. C, no look-back and no exclusion permitted. D, a 6-month look-back and 6-month exclusion. Don't overthink it, which one feels right? The correct answer is D, a 6-month look-back and 6-month exclusion. D is correct because Pennsylvania long-term care policies may look back only 6 months before the effective date for pre-existing conditions and may exclude such a condition for at most 6 months afterward. A is wrong because doubling both periods to a year would extend the insurer's reach well beyond what the statute permits and would leave applicants exposed longer than the Commonwealth allows. B is wrong because a permanent exclusion would defeat the purpose of buying coverage for the very conditions that make care likely. Long-term care rules cap the exclusion rather than allowing it indefinitely. C is wrong because eliminating pre-existing condition provisions entirely would invite people to buy coverage after a diagnosis. Pennsylvania limits the practice rather than forbidding it outright, and the statute names both periods. Long-term care insurance needs a way to handle pre-existing conditions because without limits, people could wait for a diagnosis and buy coverage right before filing a claim. But with unlimited exclusions, insurers could deny the very conditions most likely to need care. Pennsylvania resolves this by capping both sides of the problem. The look-back period reaches 6 months backward from the effective date and defines which conditions count as pre-existing. The exclusion period runs 6 months forward from that same date and defines how long those conditions stay uncovered. Both numbers are 6 months, which is the single most useful fact to remember. A condition treated 8 months before the policy falls outside the look-back window and is covered from day one. A condition treated 3 months before issue falls inside the window and is excluded for 6 months, after which it's covered like anything else. Long-term care buyers are typically in their 50s or 60s, and nearly everyone that age has some medical history. A longer look-back would unfairly capture routine treatment from years earlier, while a longer exclusion would leave buyers paying premiums for coverage that excludes the very conditions they're most likely to need. 6 months in each direction addresses anti-selection without gutting the policy. Other states and other insurance lines use different combinations, so a vague sense of a year or two will lead you astray. For Pennsylvania long-term care, it's 6 and 6 in matching figures, and reading for the product line before recalling the numbers is always the safer approach. Question 48. A Pennsylvania producer identifies a material conflict of interest in an annuity recommendation and must decide how to handle it. Which of the following describes what the Commonwealth's conflict of interest obligation requires, and how ordinary compensation is treated? Your options are A. Eliminate every conflict. Commissions are conflicts. B. Avoid, manage, or disclose. Commissions accepted. C. Disclose in writing. Waive all commissions. D. Report conflicts to the department annually. Got a guess? Lock it in. The correct answer is B. Avoid, manage, or disclose. Commissions accepted. B is correct because the conflict of interest obligation requires a producer to identify and avoid, or reasonably manage and disclose, material conflicts. Ordinary cash and non-cash compensation is by definition not a material conflict. A is wrong because demanding elimination of every conflict would make most recommendations impossible, and treating commissions as conflicts would end commission-based distribution. The article rejects both propositions. C is wrong because writing is one way to disclose, but the obligation offers avoidance and management as alternatives. Requiring producers to waive compensation appears nowhere in the statute. D is wrong because annual regulatory reporting of conflicts is not part of the framework. The obligation runs to the consumer at the point of recommendation rather than to the department later. The best interest standards conflict of interest obligation rarely works the way its name suggests. It does not demand that conflicts disappear, and it does not treat commissions as conflicts at all. The obligation requires a producer to identify material conflict and then avoid it, manage it, or disclose it. Avoidance means declining the transaction that creates the conflict. Management means structuring the deal so the conflict does not distort the recommendation. And disclosure means telling the consumer what the conflict is. The producer picks whichever response fits, and the standard is reasonableness, not perfection. Requiring zero conflicts would end distribution rather than improve it. Any form of compensation gives a producer some differing interest. Representing a limited number of carriers limits what can be recommended. And deeper experience with one product type naturally shapes what a producer sees as the solution. Ordinary cash and non-cash compensation are by definition not material conflicts under the article. That is a deliberate drafting choice, not an oversight. So compensation is routed instead through the disclosure obligation, where the producer must state the sources and types of compensation received. Disclosure alone has a mixed record, so the framework leans on the care obligation to do the real work, requiring a reasonable basis for every recommendation regardless of compensation. A producer who recommends a higher paying annuity without that reasonable basis violates care, disclosed or not. Question 49. An insurer explains to a new producer that as the number of similar exposures it covers grows larger, its predictions of how many losses will occur become steadily more accurate. Which of the following principles is it describing? Your options are A. The principle of indemnity, B. The doctrine of reasonable expectations, C. The law of large numbers, D. The principle of utmost good faith. Which one is it? Pause the video if you need more time. The correct answer is C. The law of large numbers. C is correct because the law of large numbers holds that the larger the group of similar exposures, the more accurately an insurer can predict losses. Reliable prediction is what makes rate setting possible. A is wrong because indemnity limits recovery, so an insured is restored without profiting from a loss. It governs how much a claim pays rather than how losses are forecast. B is wrong because the reasonable expectations doctrine interprets ambiguous policy language in favor of the coverage a buyer would fairly anticipate. It is a rule of construction rather than a statistical principle. D is wrong because utmost good faith requires honesty from both the applicant and the insurer during contracting. It concerns candor rather than the mathematics of loss prediction. Insurance is often called risk spreading, but that phrase hides the real mathematics. Spreading risk doesn't make any one person's outcome more certain. What actually grows more certain is the insurer's ability to predict losses across the whole group. The law of large numbers says that as the number of similar exposure units grows, actual results converge toward expected results. An insurer of 50 homes can't predict next year's fires with confidence, but an insurer of 500,000 homes can, even without knowing which specific homes will burn. Two conditions matter and are easy to overlook. Exposures must be homogeneous, meaning similar risks are like enough to share one loss probability, and independent, meaning one loss doesn't trigger others. An epidemic correlates losses across an entire book at once, which is why catastrophic risk needs reinsurance instead of ordinary rate development. The most common mistake is thinking a run of claims makes future claims less likely for one individual. That's the gambler's fallacy. Not this principle. It's also distinct from indemnity, which limits claim payouts, reasonable expectations, which interprets ambiguous policy wording, and utmost good faith, which governs honesty and contracting. Whenever a question describes prediction becoming more reliable as similar exposures grow in number, that's the law of large numbers at work. Question 50. A Pennsylvania employer sets aside a period each year during which employees who previously declined the group health coverage may join the plan without answering any medical questions at all. Which of the following names that annual period? Your options are A. Open enrollment, B. The probationary period, C. The contestable period, D. The elimination period. Take a second. Which answer would you pick? The correct answer is A. Open enrollment. A is correct because open enrollment is the annual window during which employees may join or change group health coverage without evidence of insurability, which spreads enrollment decisions across the whole group. B is wrong because a probationary period is the service requirement a new hire completes before becoming eligible. It applies at the start of employment rather than recurring each year. C is wrong because the contestable period limits how long an insurer may challenge a contract for application misstatements. It is an individual policy provision rather than a group enrollment window. D is wrong because an elimination period is the waiting time before disability or long-term care benefits begin after a claim. It has no role in deciding when someone may enroll. An employee who declined coverage 2 years ago now wants back in. Group insurance handles this not by screening her health, but by controlling when she's allowed to decide. Individual insurance controls risk by examining each applicant's health. Group insurance controls it by restricting when anyone may decide, forcing choices before the year's health outcomes are known. Open enrollment is the annual period when eligible employees may join or change group coverage without answering health questions. It lets previously declined employees enroll and current enrollees adjust their options, all without regard to health. 3 look-alike terms guard different moments. A probationary period is a one-time wait for new hires to become eligible. A contestable period limits how long an insurer can challenge misstatements on an individual policy. An elimination period is the wait before disability benefits begin after a claim. Special enrollment periods, like a spouse losing coverage, work the same way for the same reason. Verifiable life events don't create selection problems. Whenever you see an annual window to join group coverage without evidence of insurability, that's open enrollment. And that wraps up today's full practice review for the Pennsylvania Life, Accident and Health Insurance exam. If you want to keep practicing what we covered today, head over to our website, linked in the description below. You'll find hundreds of free practice questions plus complete study guides covering everything you need. It's honestly one of the best ways to sharpen your skills and build real confidence before exam day arrives. Go check it out. Subscribe so you don't miss our next practice set, and good luck on your exam.